Welcome. I'm your host, Henri Arslanian, and welcome to this episode of the Future Money Podcast. Before we start again, I want to say a big thank you to the 500,000 of you who follow my content each week. This podcast, The Future Money, is now ranked in the top 5% of all podcasts globally on Spotify. Really, thank you to the thousands of you from over 160 countries who are tuning in each week for the new episode of the Future Money Podcast. So thank you guys. Really appreciate it from the bottom of my heart. And as all you loyal listeners know, the goal with this podcast is very simple. It's to go deep in some of the biggest ideas, trends, and developments we are seeing in the field of crypto, and hopefully empower you with this information, and then let you make your own decision on what their impact can be on the future of money and finance. And to do this, I invite each week one of the leading figures of the global crypto community to have this one-on-one conversation amongst crypto aficionados and discuss some of these topics. My guest today is Jean-Marie Mognetti. He's the CEO of Coinshares, a company that's been in the news a lot recently, especially with the ETF news. And we're going to cover a whole range of topics, not only from on the ETF side, but also on the broader impact that it can have on the broader ecosystem and moving forward as well. One fun fact, by the way, you may not know about Jean-Marie is a part of being a CEO of Coinshares, he's an avid polo player, well, especially back in the day, but when he has time as well. Jean-Marie, I hope our podcast is as exciting as a polo game. Welcome to the Future Money Podcast.
Thanks, Henri, for having me. Yeah, it used to be the case when I have more time on my hands, like not so much these days.
It's often the case. It's like I still love playing hockey and other stuff, and unfortunately, when other things come up, it becomes a bit tricky. Jean-Marie, thanks for being on the show. There's a couple items we want to jump right in today.
Sure.
Before we talk about the ETF approval and also really dig deep in some of the implications of the ETF and also how the ETF works as well. Can you maybe give us a bit of background on yourself and on CoinShares so that our audience is aware of the background?
Yeah, sure. So my background is commodity trading. I started trading commodity right after college, and we moved into crypto as early as 2013. So me and my business partner, Danny Masters, we keep going with our commodity hedge fund into crypto, and eventually this become CoinShare. So it has been a journey. We started in 2013. We get the first regulated hedge fund launch in 2014. The first ETP launched in Europe in 2015, and since then we just keep growing up the CoinShare brand. Funny enough, we talk a lot about BlackRock these days. BlackRock own iShare, and when we created CoinShare, our fellow friend Ryan Radloff said we're going to call it CoinShare because there is iShare, so there should be CoinShare. And that was a very early decision, which today makes a lot of interesting noise.
It came a long way, huh? Think about it. My
Yeah.
God, on that side. So can you maybe let's jump right in. I want to talk about obviously the ETF approval. There's been a lot of discussions in the media about the impact short term that the ETF can have. Maybe can you share with our audience more? What are your thoughts on the impact it can have medium and long term and on the broader crypto ecosystem?
Uh, I think the whole question about the impact of the Bitcoin ETF is due to the very nature of Bitcoin. And, as we all know, Bitcoin has a very limited supply, which is, hard coded in code. So you can't really change it, despite what Jimmy Dimon is saying. 21 million is 21 million. And that's your kind of supply hard coded. At that point, an ETF coming up is creating kind of a massive shock of demand on a constrained supply. And this kind of asymmetry between offer and demand is always seen with our former commodity hat on as a very strong catalyst for kind of a long-term change in the way people consume and buy this product. You saw it in a lot of commodities in the past. CoinShare used to be trading under its old name, Global Advisors. The going into the gold ETF, the approval of the sugar ETF, the cotton ETF, all this kind of soft and ags product, which get the same kind of supply and demand constraint on a very different matter. The Bitcoin specific ETF is very, very unique in the fact that whilst you can always find new source of gold, for instance, the Winklevoss mentioned last time it was gold on Mars. You can't find new source of Bitcoin. There's only 21 million. When they all mine, end of the story. And if you make the math, there is not enough Bitcoin for every millionaire in the world to get a full one. So the kind of asymmetry is very, very deep. Short term, there's a lot of kind of, I would say, dust which need to settle. There is a lot of people who were in grayscale for a long time. We don't really know what's going to happen in this kind of environment. You get the new one coming up. So you get a lot of trading in, trading out, reallocation, rebalancing. You can see Cathy Hood moving from which a GBTC position to a BITO position to something else. So you can see all this kind of horse trading kind of allocation, which create a bit of noise around the entire Bitcoin complex right now. I think, in the medium term to long term, especially if you compound the catalyst of the halving coming up, this is going to have a very interesting impact on the trajectory of Bitcoin.
Yeah, very interesting, actually. But can I just talk about the GBTC impact, right? So, but I love your Jamie Dimon example. I watched his interview that I gave at Davos of challenging the 21 billion Bitcoin. I mean, I felt bad for the people working at crypto at JP Morgan that day. I was like, man, these guys must really put their hands in their head in their hands that day. It must have been quite an embarrassing moment, but it is what it is. Probably
It
they
just shows you
reached a
sometimes
brilliant time.
the organization is so big that the head doesn't know what the hand is doing. And,
Exactly.
JP Morgan is the underwriter of Circle IPO, I think. So, it's kind of crazy to see this kind of attitude.
Yeah, his bankers on that deal must have had a interesting set of conversations with the Circle team. But that's one for over drinks one day. But actually, let's mention about the GBTC topic, right? So, there's obviously a lot of noise post announcement. How much of it do you believe is due to the GBTC, sell off, if you want, people actually migrating from the GBTC to other positions, other ETFs? I'm sorry. Because obviously, Jean-Marc, on
Look,
that point, there's been obviously a lot of noise about it, a lot of conversations. And of course, when we look at the product, even the fees charged by GBTC versus what are charged by ETFs, the natural inclination many have is actually there's a rotation out of GBTC to ETFs. To what impact do you think the GTPC has an impact on the price action we've had on and the inflows on Bitcoin ETFs?
First of all, I'm not Barry. I'm not Michael Sunshine, so I'm not running Grayscale. So I can't really have enough insight into what their really decision was. Now, when I look at it and I look at the data as they have, there's a few points to consider. It's like one is like what is the kind of average duration of the people we have in the book, and they can calculate that. How do they hold this kind of asset? Is it like through tax preferred vehicle or not? And if it's not tax preferred, then there is potential capital gain to pay the day you crystallize. So if you think about it, moving from if you move $100 from a high fee paying vehicle without the tax setup done to a lower fee paying vehicle, yeah, you're going to save probably 100 basis points on the fees, but you're going to lose 33% on your tax. So you're going to go from 100%, $100 investment base to a 70% investment base just to save 100 basis points. So this arbitrage of the fees might be something which drives their decision to say, you know what, we're going to keep our products, the fees where they are because people would be not incentivized to swap. Now, we saw a lot of sell-off on the vehicle today or over the last few days. That was to be expected anyway. As you know, a lot of people have been, screaming for years for being locked up in GBTC. And second of all, you get a lot of companies who went bankrupt over the last, 2, 3 years. And a lot of this company went bankrupt because some of their risk management position were to deal with GBTC playing the arbitrage of the premium and discount window. And, so you can see there was a court case between the liquidator of FTX and Grayscale. The liquidator dropped the case, sold the position, and now we're all good. So that was $1 billion or so of outflow. You probably get the same thing with BlockFi around the corner, which is happening as well without the same kind of noise. And then you get all the people who were playing this trade effectively, who were locked up and who were long, so who were effectively as a long GBTC and short something else, and like have to unwind the trade and finally unwind the trade. So you get all this kind of cycle and recycling, and I would say horse trading. Cathy Hood is a perfect example of that, of horse trading. She moves the position out of GBTC into BITO back into now ARC21. So it's kind of all kind of going around. And the question is like, is it net positive? Is it net negative inflow, outflow? That's the kind of math which needs to happen. And it will take, I think, a quarter for the dust to settle and for people to start seeing really what is really happening in the dynamic. Like right now, it's too early out of the gate.
So, Jean-Marie, obviously, you at Coinshares, you guys spend a lot of time looking at the various ETF models, and I'm sure there's been numerous back and forths that took place with the SEC and the regulators. For the benefit of our audience, can you maybe explain? I think the audience knows how an ETF works, but maybe you do a little refresher. But especially in this case with the Bitcoin ETF, there's a big debate between the in-kind mechanism and the cash mechanism when it comes to how the
Yeah.
Bitcoin ETFs would work. Can you explain to us the differences between both and the practical repercussions that they may have for investors, especially American investors?
So let's look at what's happening in Europe because Europe was a kind of I would say, bedrock of this ETF in crypto. And the European model used what we call the exchange-traded commodity model, where every creation and redemption around the ETF mechanism is done by what we call authorized participants, which are the only people who are allowed to interact directly with the issuer to create and redeem shares at NAV. And the creation and redemption of share at NAV is done in exchange for the delivery of an exact number of the underlying commodity. In our case, Bitcoin, but it could be any kind of other cryptocurrency you want. So the AP could be Jane Street, could be Flow Trader, could be DRW, is basically putting an order in at 1 o'clock, saying, I'm going to deliver to you tonight 10 Bitcoin, and for 10 Bitcoin, I will receive 10 shares, to make it simple. And that's kind of the logic around the in-kind creation. The beauty of the in-kind creation, especially in the post-2008 era, is like it removes every single risk on the investor because the people carrying the risk are the AP. The issuer itself, which is a ring-fence bankruptcy remote vehicle, which is there for the investor to invest in and feel safe, is isolated from the market fluctuation because he only receives the right amount of underlying at NAV price. So there is no slippage, there is no breakage, and everything is like very transparent. It removes also the risk for the issuer to become a trader, start trying to play and time the market. The issuer just remain an issuer, don't do anything else. As such, all the risks are with the AP or the authorized participant. So it's a very pure, elegant model which works extremely well and protects the investor to the end degree. That's the kind of ultimate investor protection. That the issuer just do what it does, issuing, nothing else. In the US, there has been a bit of a change of the model. This model could have been applied, and it was a model which was supposed to be applied at the beginning when we were having discussion of the SEC. That was the kind of model which was supposed to go out to the market. However, it's the US. There's a lot of tension. There's a lot of Chinese whisper. And for some reason, the SEC decided to change the tack and say, no, actually, we don't want in-kind creation. We want cash creation. My theory around that is because the people who are I would say, authorized participants are also traders of coins, but the traders of coins are not done in the US because of the buy and sell of coins is not done in the US because of rules like, there's no real rules around broker-dealer having a crypto activity in the US right now. So most of these broker-dealer have outsourced this function to some of the entity offshore. And effectively, you get the creation done by the broker-dealer in the US and the delivery done by an offshore entity. And I think the SEC was, minded to decide that it was not an ultimate and safe way for retail investor. And it was kind of like changing the perception. As a result, they say, okay, we're bypassing that all and we're going to go for cash creation. The flip side of that is say, actually, the real reason is because Goldman can't create for cash or for real coin, or JP Morgan, or because if you look at the big APs in the US compared to Europe, in the US, the big APs are banks. Now, the banks can't touch crypto for sure. So if the only way to create is to deliver in-kind Bitcoin, then you have another problem where the banks are out of this, what looks to be a very lucrative business. So the way to keep everybody happy was to say, okay, we're going to do not in-kind creation, in-cash creation. So every single Wall Street traditional AP, whether they are Goldman, JP Morgan, Morgan Stanley, UBS, can play along with the more traditional AP we saw in Europe, like VO2, Flow Trader, and and they also and Genstreet. So all this kind of like macrocosm happen. For different reasons. We don't have the final answer. There is only hypothesis here, and nothing, and there is no smoking gun. So we can only look at it. The problem of that is like it makes the operation very complex. It requires financing for the issuer. It requires the issuer to trade. Now, compared to what I said before, where it was creating a slippage risk on the vehicle itself, well, it still creates a slippage risk. The only difference, like this time, it's passed back to the AP who is effectively carrying this risk, and the AP will effectively, as a result, price it not as competitively as it would price it if it was in-kind creation. So net, there is no worse risk in this kind of case in the US within the issuer itself. However, there is a degradation of the spread and the pricing capacity, especially on the OTC market when you want to create a big order through the AP directly. What that you will get in Europe, for instance.
Yeah, so there will be slippage actually, and I think how you explain the in-kind model makes a lot of sense. Can you just explain a bit more, go one level down on the in-cash model as well for listeners to understand? And obviously, especially when the sale is happening and the assets are moving to cash, and obviously you mentioned the risk there, and I think your thesis you mentioned with a lot of the big banks being able to play a role in the in-cash model. I think one that many people have discussed, and frankly, I think there's a lot of merit there. Which is a whole different discussion. But I mean, on the in-cash model, can you go a level deep? Like, for example, where actually the cash transaction is happening, and a part of the slippage, if there are any other negative consequences as well for
Yeah,
investors.
so let's decompose and do step by step.
Yeah.
So you get your issue. So you get effectively Henri who want to buy $10 worth of this Bitcoin ETF for whoever. Let's say Valkyrie for sake of an argument. You want to buy $10 of it. You call your AP. Your AP at that point is like, let's say JP Morgan. So you call JP Morgan. JP Morgan say, okay, I take your order. So they're gonna price it to you right away. And then by 1 o'clock, JP Morgan gonna call Valkyrie and say, for end of day today, I want to create, let's say, 10,000 shares. Okay. And then 10,000 shares, they're going to say at NAV. So they're going to create 10,000 shares at NAV. So most of these ETF have the same NAV window, which is a 3 to 4 pricing window based on the CME reference rate index, New York time. So that's kind of like the flow up to the creation point. Now, on the issuer side, the issuer at that point receives a creation order from JP Morgan. So the issuer going to wait to receive all the order from all the AP he has, so as he get a chance to net all this order together. And the netting going to give him one number, say, okay, the sum of all this kind of AP action, which is my bench of APs, give me for today, I need to buy 5 Bitcoin for these shares. So now he go in the market, but now you need to go in the market and buy 5 Bitcoin. Problem is already the AP don't have cash. Sorry, the issuer doesn't have cash because the AP didn't deliver cash yet. The AP only going to deliver cash through DTC at T+1, maybe T+2, depending on the settlement window, when you deliver the share back to them. So the issuer had to find a financing mechanism to be able to go buy this Bitcoin in the market. Right now, the financing mechanism probably costs 10% annualized cost of capital. So that's kind of a cost they have to carry. And then they have to buy this Bitcoin, okay? Then they have to move that in custody. And when it's in custody, then the administrator ticks the box, say, okay, we have more Bitcoin in custody. We can now issue the shares. And then the shares through DTC will cycle back to our friends, the AP. Now, when you think about friction and slippage and where the tension happens, so think about it. You get the cost of capital because you need to pre-buy. So you get a one-day financing on that stuff. Then you get the cost of trading. Because most of these issuers are not professional traders. So the cost of trading is not the same cost as if they were a market maker. And then you have to move that to custody. So all this stuff together end up adding up and creating effectively pricing slippage, which are not impacting the fund itself because the fund will recharge it to the AP. So the AP ultimately will recharge it to you, Henri. So you will be the one who will say, okay, I get my price, but your price is not as good as it could have been.
Yeah, exactly. And that's what I think that's what I want you to for our audience, because you could argue if you look at this objectively, the investors are worse off in cash model than actually in kind model. And actually, really, the dilemma here is okay. Is there a counterparty risk? When you're having an in-kind model versus the in-cash model. I would argue actually some of the slippage and these fees, actually the customer, the investor is going to bear the cost of these, right? Do you have an idea? But is there data? I haven't. I read
I
many of the.
think funny enough, the nobody complained on the way in. The problem is on the way out. Because the question is like if it's in cash redemption, how much the market can digest in one go? If everything needs to be sold all the time, so you really have this kind of like asymmetry,
Yeah.
and that's why it's not like it's not the best idea ever. Because what if the issuer, imagine you get all this issuer now in the market, imagine they all get a lot of outflows, and imagine there's not enough. We saw when the treasury market was maxed out in March 20 or March 21, I don't remember exactly the day, but there's a number at which there is nobody buying anymore because there's not enough liquidity in the market, and that's
Yeah.
kind of this kind of asymmetry where Bitcoin is still a very small market, and you have a potential risk. But what we believe at Coinshares is like the SEC will eventually move to the in-kind model. It's kind of an evolution process where they started with cash, they understand that process, and then they're gonna move to in-kind. It's kind of probably an evolution, and we hope it will evolve this way, where we're going to be able to step by step move toward at least having both options, in kind or cash.
Absolutely. I think I hope that's the way it's going to evolve. And the question is when, of course. On the in-cash model, out of curiosity, Jean-Marie, has there been any analysis of the cost actually today? I know obviously there's not much volumes right now, but what could be the actually expected cost that an investor would be bearing in in an in-cash model versus the in-kind model?
It really depends on the
The
counterparty. It
market.
really depends on the AP and how much flows they have because they can net some off. But like
Yeah.
if you think about it, you're probably talking on top of what you pay naturally to your brokerage house, you're probably talking, anything between 4 and 8 basis points. I know it's a big spread. I'm sorry, it's a
Yeah.
100% margin here I'm taking, but like it really depends with which issuer
Absolutely.
you're talking, how familiar they are to optimize things, and funny enough, the small one are better off at that game than the big one because if you look at a company like Valkyrie, which CoinShare took an option to acquire last year, we're doing that in and out. So we have the relationship to optimize that very, very aggressively and to minimize our cost of capital. And you go to people who are not doing that and who don't manage who don't integrate the whole vertical, then you have bigger cost of bigger costs.
Absolutely.
All in all, I think it's working for now. It's not optimal, and it's only going to improve.
Yeah. I think it's going to be very interesting to watch. And I think you're right. Ironically, many of the people may go for some of these big players, but actually some of the ones that have some crypto niche actually may benefit from at least on this element, right? Which brings me to my other question I want to ask you, Jean-Marie, is when we looked at that initial set of Bitcoin ETFs, right? The fees are actually quite low, from anywhere from 20 basis point, 50 basis point. The fees are actually quite on average are quite low what we are seeing. And in many cases, it's been waived at the start, right? Until a certain threshold has been hit. What do you see on the fee perspective? When we look at this conversation a year from now, 2 years from now, are we gonna go to a world where basically the fee on the Bitcoin ETF is a race to the bottom? Or is this an area where you think that there'll be fees that'll remain? And linked to this, who could win it? Is it an AUM game? Is it an optimization game? Is it a game where specialization matters, brand matters? How do you see this playing out?
Okay, so let's take all the question and one by one because there's a lot of questions in one question.
Let's
So
start. Let's start initially with the first question of the. Let's start with that, and we'll move to the afterwards.
so your sorry, which one was the first one now? Like which one you want to start with, Henri?
Let's start actually with the first one on the fees. Do you think, or you do believe that over the
On
next
the
couple
feed.
of years we'll
I
have
think to
actually
be
fee
fair, I think
compression?
what's happened on the feed is an accident. I don't think any of the issuer end up at that price this way. It was like it's a total accident, and it was like poorly managed, if I'm honest, because you're in a position where nobody's going to make money out of the Bitcoin ETF unless you have billions and billions of dollars of AUM. And even if you have that, the kind of margin on it going to be very, very thin because you have to factor all the cost of custody and so on, which is going to eat your effectively margin pretty aggressively. So it's not like it's a loss leader advantage. It's not the kind of something you're doing to make a lot of money. So all these guys who are launching now, they're not going to make the grayscale type of money. That's for sure. So I think what's happened, if I'm honest, is like people panicked at the end of Q4. Um, and so if you look at what was happening in the strategy, BlackRock were keeping their fees confidential. They were not disclosed. And on the 29th of December, there was a final deadline to file an S1 with the SEC. And our good friend Mike Novogratz came out on Twitter and everywhere saying, we are the cheapest one in the market, and here's our fees. And the fees were like 50% lower than the other one who disclosed a fee. So at that point, people start panicking, thinking, oh, the race is on for a war on fee. And then Fidelity reacted, and then Franklin reacted. And so it was just like a chain effect. Whilst it could have been, our initial as Coinshares estimate was that the fees will come out at 59 to, between 49 and 59 basis points was a fair pricing for the product. And that's where it should be. Yes, you can always have a kind of a period of free of fee holiday to incentivize people. That's a different story. But the kind of a fair value should have been there. The fact has been trashed down to 20 basis point and 21 basis point in some case is just like kind of a race to a point where there is very, very, very little way you can justify that it makes economic sense.
Yeah. It's
And
very
now for the
interesting
other question about who's going to win, the other
just
question
from
of
your
who's going to
perspective, who
I
can
think
win
it's
the
a question of like, not everybody competes in the same bracket anyway, So if you are Fidelity Fidelity, BlackRock, and maybe Invesco are kind of on their own kind of like, there's this good journalist from Bloomberg call it like the coin derby or whatever, but effectively it's like there is several races in the race. You can't really compare everybody the same way. So you get like the traditional big firm from Wall Street like Invesco, BlackRock, and what's the last one? Fidelity, which are kind of this big trio. Franklin Templeton should be in it as well, but clearly that doesn't work the same way for them. So they're already kind of losing traction there. And then you get like I would say a second batch of Wall Street firms like Hashdex or Vanex. Sorry, Vanek or Wisdom Tree. And then you get some, crypto specialists like Valkyrie, which we are helping, or Bitwise. And the question is going to be, okay, well, who is the winner in each category? And, in the US, merger and acquisition of ETF is kind of a sport as well, and something which is very easy to make, what is much more difficult to do in Europe. So at some point, we can also expect some platform consolidation and some people saying, well, actually, I need someone specialized and an expert on that. What I do believe, however, is like in terms of sale and distribution, when you are a big house, like one of the top Wall Street house, your sales team is incentivized to sell plenty of stuff. So they sell what works on this week and what is hot on that day. However, and we can see it with Coinshares in Europe. Our sales team in Europe, they just sell crypto day in, day out, specialize in crypto. Our research is focused on crypto. We have subject expert matter on crypto we can bring to any meeting with our clients. So it's a very, very different franchise for us than for a big house who has 1,000 other products to sell. So I think long term we'll see where it goes, but there is definitely a place to play, a space to play for the specialist and for the expertise. And that's where we are.
Very interesting on that front. You mentioned, Jean-Marie, a bit of Europe and the activity there. Obviously, there's been a Bitcoin ETF, in Canada for some time. In Europe, we've had the ETP market on Bitcoin for some time. What have we seen in those markets in terms of development, retail interest, activity? And do you think the US, let's call it the Bitcoin ETF ecosystem, will kind of go in the same direction, or is it a completely different beast and it may evolve differently?
So in Europe, we saw. So in Europe, the adoption cycle was retail starting, and then kind of a bottom-up approach toward institution, which is a real upside-down approach because normally institutions start this kind of investment which are risky, and then eventually trickle down to retail. Today, we can see a lot of institutions in Europe which are kind of like getting ready to do something. Or getting very advanced to do some things. They were even more ready before FTX. The FTX scandal put a big kind of stop to a lot of things. And they all kind of like now saying, okay, we want to see MiCA arriving and be enforced. before we make a move. So, insurance company, pension fund, all this kind of stuff in Europe, I can say, okay, we understand that there is something to be done, but we want to see MiCA live in Europe. In terms of like asset migration moving to the US, that doesn't really exist. European products are designed for European investors. There is a natural market for that, and the cross marketing don't really work. So what you see in general is like the big house of the European bracket and the American bracket, and they don't kind of overlap. When it comes to Canada, very different market. Coinshares used to be an investor in 3IQ. We actually kind of divest this position. It's a public knowledge because 3IQ sold to Monex in December. It's public information revealed in Q4. And what we can see is like there is going to be more difficult because you're going to see a lot of migration because the cross-border trading is very, very active between Canada and the US. And you're going to see a lot of people say, you know what, I'm going to move my investment from this vehicle to this vehicle, subject to them being in the right taxable environment wrapper. So if you are in the right wrapper, you can make this little arbitrage. If not, you have a problem. So I think the Canadian ETF market going to suffer from the US competition. And then when it comes to the US, I think people were like all expecting a massive explosion of the AUM day one. At Coinshares, we were very, very skeptical about this whole idea. And that's why we took our time with our acquisition and we just like keep working through it right now because our idea is like people who wanted to be in for the ETF launch had a million ways to invest, a limited number of ways, but they have ways. So they could have bought GBTC with a spread and a discount compressing. They could have bought Coinbase as a proxy. They could have bought Bito. They could have bought plenty of different vehicles to try to do something and get the exposure. So the wallet which are available now, there's still plenty of wallet available in the US. It's a 10 times bigger market than Europe, so there's plenty to do. However, these wallets need education. So they're not going to just jump because there's an ETF. They're going to jump because there's education. Moreover, a lot of platforms, which are kind of the wirehouse in the US to buy this kind of product, where the IRA are buying through, are requiring you to get 6 months track record, 8 months track record before they list you on the platform. So you get all this kind of trickling effect. It's not like you turn the button and up you go. Even if you're a big platform, the product will need to go through the hoops of approval, regulatory documentation, all this kind of stuff, which will make it eventually available to a wider audience. So it takes time, it's just not something, and that's why we're not like, no, it's not going to be an explosion day one. All the people telling us Bitcoin price is going to be 100,000 after the ETF, we were like, no, calm down. It's not exactly what's going to happen. It's going to be very different. It's it's much more of a long-term, very profound and deep transformation movement than just a shooting for the star, effectively.
Were you surprised to see some of the big brokers, I think Vanguard was one of them, basically not allow their customers to buy this Bitcoin ETF? Do you believe it was really because of their regular compliance procedures that needs to be X months of track record? Or do you believe there was something else that a lot of these big financial institutions decided literally not to allow their clients to actually get Bitcoin exposure via the Bitcoin ETF?
It's an interesting case. So Vanguard was not the only one. I think Merrill was quoted as doing the same thing. UBS was quoted as doing the same thing. In the meantime, UBS was an AP as well. So the kind of the logic of that was kind of beyond my understanding. But, I think this kind of, the Vanguard case was very clear. I think the bank, we don't know. Vanguard, I think the statement was made very, very early on, and it was very, very clear. And people were like, okay, we don't want to support it and we will not support it. Eventually, people will vote with their feet. You can't, some people, you're in Dubai this day, Henri, so you know how Sharia investment works. And if you want to invest in a Sharia compliant environment, you don't have access to this product. And to some degree, Vanguard make their own rules and say, okay, we don't believe that's kind of investable, so we don't do it. And if you don't like it, you can always move your account to Fidelity, and you could move your account to Schwab or wherever you want to trade. So, at the end of the day, it's a free market. People do what they want. And if they want to find a broker who authorizes them to trade, they will move.
Yeah. It's been very interesting to see how the reaction has happened on that front. One last question, Jean-Marie, before we move to the round of questions. What do you think the impact of the Bitcoin ETF could be on the crypto exchanges? So, for example, let's take an average retail buyer that wants to put, let's say, $1,000 in Bitcoin. Before would go to a Coinbase, a Kraken, or other exchanges in the US, and will open an account, buy their two Bitcoin, leave it there, and forget about it. Now, the same person has the option to go buy the Bitcoin ETF, right? How do you think the impact? Do you think the impact on crypto exchanges is positive, negative? And how this interaction could evolve over the next couple of months and years.
It's a forbidden question you're asking. As you know, I've been in this industry for a long time, so all these people running exchanges are very good friends of us. However, I do believe it is starting a transformation of the way people consume crypto. Uh, because yes, you get the crypto trader and the people who will always trade on Bitfinex, always trade on Kraken, always trade on Gemini, depending where they are based. And they will have their favorite exchanges depending on the jurisdiction. However, for the normal, you know, trader who is just placing his 401k in the US or trying to allocate kind of retirement money, the simplicity to be able to click on buy on an ETF versus opening an account at Coinbase and paying 25 basis points to trade every single trade versus paying 20 basis points to BlackRock or to Valkyrie is going to be a very, very kind of interesting arbitrage. And I think at some point you can't, you know, I think it's Kant who used to say that the human nature is lazy by definition. So, you know, if I tell you, let's go open another account, you're going to tell me, okay, I can do it here. I'm going to stay where I am. So the facility and the easiness of access and the absence of friction is what makes the difference. You know, like the UI and UX experts are always talking about how seamless the experience is. Well, if you can just stay on your Schwab account and buy something somewhere, you know, something which do exactly the same, I think human nature will make you do that. So I think deep, you know, the real case is how does that impact the real? I think it's really specific to the American exchange, by the way. Actually, it doesn't really impact the offshore exchange. So it's really for the onshore exchange in the US, who will have a natural competitor effectively. And actually, it's not just one; it's like 7 or 8 competitor, which have just been creating overnight to their own activity. People will say, yeah, but that's just Bitcoin. Well, don't forget that Bitcoin is like 80% of crypto market cap, and the rest is Ethereum, and then the rest is all the rest. So it's kind of going to be very interesting to see how this is impacting long term the economics of all these exchanges, which has been running on a lot of marketing, on a lot of expenses, and a cost of acquisition, which are not always very well managed and very well controlled. It's going to be interesting to see how it works. Now you get real people who know how investment process work. So we'll see. It's an interesting debate, and I would be happy to look at the numbers in 1 or 2 years with you.
Absolutely. I think it's going to be very interesting. Also, I think one other point to add to what you said, the incentives as well. If you're a financial advisor, if you ask your client to go on Kraken and open an account, they're not making any money. Whereas if they're pitching you the Bitcoin ETF, they're still making their AUM money on that front as well. So I think it's going to be very
Well,
interesting
you say
dynamic.
that there is a lot of referral model in crypto world, but I don't think
Yeah,
the referral model of the crypto world is kind of like vetted or good enough for the IRA industry. So I
exactly.
think you get this other issue where
Exactly.
it's like all the rebate and discount model and reference kind of points that you can get for opening an account as a wealth advisor is not exactly the same as what you would get from a Kraken or a Gemini. So yeah, definitely.
Exactly. I think it's going to be interesting to see, especially as you know, as crypto ETFs evolve over the next couple of years. Like Ethereum ETFs, we may have baskets. God knows what we'll have in a couple of years, right? So that will be even more competition on that front. I
I
said there
think
was
the
a
way you
last
think
question.
about it is just like just if you think about it, it's just like always crypto is just one allocation in the portfolio. You know, you don't
Yeah,
think, you know, unless you are like a gold bug and a crypto bug effectively, and you just do I just want to be long Bitcoin and nothing else.
exactly.
People tend to see it as okay, how many points of crypto do I put in my portfolio? And you know, you want to see that in one place. You want to be able to see the analytics in one place and be able to deal with that all together. So that's what it is.
So my said last question. I have one more, then we're going to go to the bell.
Okay, go ahead.
Obviously, Coinshares yourselves, obviously you have the ETF and you're very active in this space, but also you have long only products. You have actively managed products. How do you see the future of especially long only products, when it comes to crypto? And do you think the Bitcoin ETF could have an impact? Is it short term, no impact? Could it have a more negative impact? Very similar to what we've seen on the actively managed side, on the traditional side.
So Coinshares have two branches. Coinshares effectively has a beta allocation, which is our asset management franchise, which we run in Europe. We hope to run in the US. And Coinshares also have what we call hedge fund solution. And hedge fund solution, what is it? It's really liquid alpha. And we call it liquid alpha because we don't want it to be seen as a beta investment disguised in alpha. It's really alpha made by real people who know how to trade, who are creating return for investors based on Bitcoin as a benchmark, not based on US dollar. So if Bitcoin goes up 10% and the fund is not up 10%, we're not getting paid. We only get paid if the fund outperforms Bitcoin and outperforms Bitcoin by 10%, for instance. So the incentive of us getting paid as manager on our alpha is really geared toward the fact that we are lined up and aligned with our investors on the fact that A, we don't take money because we are benefiting from beta impact. We are making money because we are only outperforming your asset class you like, which is Bitcoin or Ethereum, because it's two different ones. I think in terms of allocation, actually, the ETF is unlocking a lot of allocation possibility because it's always very difficult for people to say, yeah, I'm going to start doing liquid alpha when there is no some beta. So it's almost like the beta is a step one of the allocation. The alpha is a step two of the allocation in the cycle and the funnel of allocation. The only difference will be that to be able to run alpha, I would say successfully, you need to get track record and a successful track record, not like a loosey track record. So you have to start early, be able to go for like 1 or 2 years with like, I would say conservative AUM and like, but good returns. So you can demonstrate to consultant, due diligence people, and all these people who are vetting and gating these investors' liquid alpha allocation that, yes, this is a good product. Yes, it is regulated. Yes, it is run properly. It is audited. The risk management system works. The team is correct. The ops working. The back office and the middle office works. It's a much more complex sell and a much more complex, I would say, due diligence on the ops side than it is on the ETFs. The ETF is all wrapped up, package is commoditized to some degree to a very, very advanced level. The hedge fund business, you can have two hedge funds side to side. They look exactly the same. The moment you open the bonnet, they look very different. And the question is like how you make sure that the beautiful body of this hedge fund outside look also beautiful inside. So it's like it needs to be like a very clean for investors inside and outside.
Exactly. No, I think you're right. I think it's the same evolution we've seen with emerging markets before. People started getting the exposure with ETFs and then the hedge funds. I mean, it's a natural evolution. So very exciting there. Jean-Marie, the bell is here. So I'm going to ask you a quick fire round of questions.
I didn't know you were a concierge as well.
And basically, I need 1 or 2 word answers. So I ask you, and the bell is here to keep us honest, and we're going to go through them. Are you ready?
Well, yeah, okay, go.
Here we go. Jean-Marie, what do you love the most about the crypto industry?
The speed.
Here we go. The fire bell is perfect for it. You've been in crypto as well for many years. I've known you for many years. What crypto CEO impresses you the most?
Giancarlo.
Giancarlo, oh, really? Tether, really?
Yeah.
We can go. That's
I can explain for a long time, but like, Giancarlo.
Yeah. What traditional financial institution is impressing you the most with their crypto activities?
BlackRock.
Interesting. If you could hire any crypto or TradFi hedge fund manager as an intern, who would you hire?
Pass.
What advice would you give to anyone entering the crypto space?
Be patient.
If you're a betting man, in how many years away are we from Ethereum ETF approval?
Less than 1 year.
Oh, wow. Really? Interesting.
Yeah. I think it should be an over under. I think it's under a year, but like assuming end of Q1 or under a year.
Interesting. Very interesting. If there is one book, publication, anything you recommend people to learn about crypto, what do you recommend?
I recommend to start with like Coinshares research report. A little bit of Bitcoin goes a long way.
Here we go. What do you do when you're not working on crypto?
I still work on crypto.
This is a problem with a lot of people in the industry. It's incredible. Everybody's so passionate. It's
It's a
actually quite nice,
24/7
actually.
industry. You never stop. It's just never
Yeah,
stopping. It's kind of a disease.
exactly. What is one movie or Netflix series or YouTube series you watched recently you recommend people to watch?
I watched a Netflix documentary on vegetarianism and how mushroom culture was a big push in the US now, and like creating new cheese through mushroom. I was like very skeptical at the beginning, and like as I was going into it, I was like, wow, this is like some serious research here going on. So from a crypto is so intangible. I quite like the ag tech sector in general, and seeing how ag tech was tagging along there was very interesting.
Amazing. If you had to take a bet, do you think Satoshi is a man or woman, and what country is he or she from?
It's fluid.
He's where?
It's gender fluid.
And Jean-Marie Mognetti, the CEO of Coinshares. Jean-Marie, the traditional question anybody comes on my show, if you had to if you could have lunch or dinner with one person, dead or alive, lunch or dinner, one person dead or alive, who would you have lunch with?
You every day, Henri.
I appreciate it. So, Jean-Marie, where can people find more about you if they want to learn more about you and Coinshares?
Coinshares.com. We have a very active LinkedIn pages as well. We have a Twitter account, very active as well, and I get a very small Twitter account as well, which is not as active as yours, Henri, but like we're learning from you, so that's good.
Well, happy it's successful. Guys, hope this was useful. And I think I'm very happy we did this deep dive on Bitcoin ETFs. I know a lot of you messaged me. They wanted to learn more about the process and how it works. So happy was hopefully it was useful. Guys, thank you very much. And I'll see you all again soon for another episode of the Future Money Podcast. See you guys next time.